Today we answer this question: what is the USDA Rural Development Loan Program? As the name suggests, the Rural Development Loan is used to buy houses in rural areas. Rural. It's a weird word, isn't it? Rural. 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 It's administered by the U.S. Department of Agriculture, so most people assume it's only used to buy houses that look like this, when in fact it's more often used to buy houses that look like this. There's no down payment required, and there's no mortgage insurance, although there is an annual fee that kind of feels like mortgage insurance. We'll get to that. And the rate is fixed for the entire 30-year term of the loan. So, can you get one of these bright, shiny rural development loans? Depends. Ask yourself these questions. Question 1, am I purchasing or refinancing? The USDA Rural Development Loan is only available for purchasing a new house. Unless you already have a rural development loan, then you can refinance into a new rural development loan. Rural. Question 2, where is the house located? Again, the USDA Rural Development Program is only available for properties in rural areas. So, you have to go to their website to find out whether or not the property that you're looking at is eligible. The website address is far too long to rattle off here, so instead try Googling USDA Rural Development Property Eligibility, and that should get you there. Question 3, what is my income? If you make too much money, you can't get an RD loan. Sorry. Best way to do it, to find out whether or not you qualify, is Google, again, USDA Rural Development Income Limits, and check to see if you can find the state and the county in which you live, and find out where those caps are. If you're underneath that, we're still in the game. There's a couple things to keep in mind, though. Number A, the income of all the people that live in the house have to be used to determine the eligibility. So if you have a husband and wife, maybe only like the husband is applying for the loan or just the wife is applying for the loan, you still have to use the income from both spouses to determine whether or not you're eligible. So if you add them together and you make above that mark, you're out, even if only one person's applying for the loan. Number B, documented child care and medical expenses, things like that, can be used to offset your income. So if maybe you're slightly over the line or right at the line, but you have $6,000 a year worth of childcare expenses and you can back that up with paperwork, well, then you can count that against it and you may be eligible. Question 4, is the house eligible? Farms, manufactured housing, houses with significant outbuildings, they're tricky. I can't say categorically that any of those three are ineligible, but you'll want to definitely make sure you talk it through with your lender to make sure the house you're considering is going to work for this program. And question 5, do I qualify for a mortgage? Once you determine the house is eligible, it's in an eligible area, and your income is eligible, you still have to make sure that you meet the lending requirements, and you can qualify for a mortgage. Qualifying entails checking out your credit, determining whether or not you have enough income to support the new debt, looking at your assets, those types of things. And also just determining whether or not you're comfortable with the payments and ready to kind of make the jump into home ownership. So here's the upside. RD is one of only a handful of loan programs that does not require a down payment. That's huge. The rate is fantastic. The rate is fixed for the entire 30-year term of the loan. There's nothing goofy about it like prepayment penalties or anything like that. It's a good deal. Normally, the less money you put down, the more you have to pony up every month for mortgage insurance. And there is no traditional mortgage insurance for the RD loan. However, there is an annual fee. Kind of feels like mortgage insurance. It's billed in with your monthly payment, but the annual fee is only a fraction of what the rural development's counterparts, like the conventional loan or the FHA loan, are much more expensive as far as how much the mortgage insurance would be. All in all, it's a really good deal. Rural. Wow. So here's the downside. Rural development charges a 2% fee on the amount that you borrow, and you wind up tacking that on top of your loan. So for instance, you buy a $200,000 house, no down payment, you wind up actually borrowing $204,000. So you're kind of upside down in the house right away. You owe $204 against the house is worth $200. So that's not a big deal as long as you can plan for it and as long as you don't have any intention of selling right away. You're going to want to make sure that you stay in the house long enough to pay down on that principal balance so that when you go to sell, you don't have to write out a big check. The other disadvantage is that annual fee that we talked about a little bit ago, that stays on for as long as you have the loan, for the entire 30-year term. Unlike its conventional counterparts, conventional loans, the mortgage insurance will fall off after a certain period of time. That rural development annual fee stays on forever. Oh, and one more thing, since the loan has to be approved by both the bank's underwriter and by the U.S. Department of Agriculture, it takes a little bit more time to get the loan through and you have to maybe jump through a few more hoops to get it. Totally worth it though, in my opinion. Here's the bottom line. Okay, bottom line, I love the RD loan program. I do. If your income's eligible and you're looking at a house in an eligible area, you should definitely check it out. It's a great way to buy a house. Bye for now. Rural.